Did you figure out the background thing?
Awesome.
No. So let's just roll with this.
Let's keep it simple. I agree.
No, let's keep it simple.
Okay, it looks nice. Welcome, everyone. Thank you so much for being here. It looks like we've already got a couple people in the comments. We are live on all of our channels. This is streaming to LinkedIn, YouTube, and Facebook. So you guys are getting a lot of exposure. First of all, welcome to another presentation by the National Association of Cannabis Accounting and Tax Professionals. NACAT Pros is a professional trade association for accounting professionals who are working specifically in the cannabis industry, working with cannabis operators and helping ensure that they are doing things correctly. And part of the organization in our training is to bring on guest speakers like the speakers we have today to help us as accountants better understand what options are out there for our clients, to help our clients better be able to perform better, be able to raise capital, be able to understand their business. And what better what better guest to have than the founders of C-Trust, which is the Cannabis Trust Score. And I will let Doten and Chip both first introduce yourselves and then introduce your business model and what you guys do for the cannabis industry. We'll start with you, Doten.
I appreciate it. Thank you for having us, Naomi. I think it's a smart and wonderful audience that you have put together that is essential to the success of this industry. So I am Dotan Melech. I'm the CEO and co-founder of C-Trust. C-Trust is the credit and risk rating and monitoring agency for the cannabis industry. It's specifically tailored for license holders, plant touching companies. We score companies. We call our score CTS, and that's going to be discussed today. With some of the questions that you may have, and that CTS, the Cannabis Trust Score, essentially acts as a credit score similar to a FICO. It's a score between 200 and 800. It consists of many, and we'll dive into it a little bit later. Data points that we collect, analyze, and organize, and ultimately results in a credit report that provides data insights to both the plant touching license holder and anyone they do business with. For the most part, lenders, supply chain, professionals, insurance companies, and so on and so forth. We are an objective third party that is looking at a cannabis business similarly to a doctor looks at a patient. We run few tests. We provide you results that are measurable, and you are able to, as a company, and of course anyone doing business with that company, to make decisions and prioritize in order to improve your risk profile.
Beautiful.
Okay, awesome. And wait, can you tell us about you and how you got into this?
Whoa, how much time do we have? I'll make it short. I was introduced to the cannabis space back in late 2018, early 2019, by being invited by a group of creditors, among other individuals that used to do similar things to what I used to do. And I'll speak to it in a minute. But I was invited to be a receiver over a vertically integrated cannabis operation, probably one of the largest in the state of Nevada, called CW Nevada. You can probably search the case and see that there's nearly 1,400 filings in this case. So one of the largest that I've been involved with. My background prior to acting as a receiver in this particular case, that's how was my first introduction, I guess, drinking out of a fire hose at the time, I was a court-appointed receiver and a bankruptcy trustee in Region 17, and I've done a lot of consulting and reorganization and restructuring work for banks all over the country. Bank of America was one of the clients that I used to work and consult for, and I got involved for the most part in helping companies that went sideways, either at early stages as a preventative approach, or when things are too late if you will, and it has to go through the legal route. So my background, again, is to be on the bad and ugly. C-Trust is here to go to the other side of the fence and use all this institutional knowledge and experience to prevent it from happening in the first place. And that, to me, and I said to anyone that willing to listen, C-Trust for me is redemption. I hope that provides some background for you on how this came about.
Yeah, absolutely. All right, go for it, Chip.
Yeah, so first, Naomi, thanks so much for having us, and it's great to see you again. You don't call anymore, you don't write. I miss you. No, I'm kidding. Yeah, for everyone in the audience that's listening in, I am an accountant too. I've spent almost 30 years in big firm public accounting. Back in 1819. I too came out of the closet, if you will, and found a way to start my own firm that blended my desire to bring cannabis entrepreneurs into the capital markets with my viewpoints on this burgeoning industry of cannabis. And then a couple of years ago, met Doton and the rest of the crew. Was so impressed with the alignment of what C-Trust was doing and building with how I saw cannabis entrepreneurs can be served, and cannabis businesses can access capital. And so we became fast friends. I joined the team as the CFO shortly after that, and we are here today to talk about the main things that we're doing, which is help lending institutions, help financial institutions understand all of the risks related to cannabis so that they can make informed decisions, and help cannabis related businesses understand all of their risk, understand what their financial situation looks like. I like how Doton said it in terms of what is their financial and operational health. And then once they understand that, be able to apply that to get better rates on lending, better terms. And then finally, why I'm so excited to be here today is because I am an accountant, and I love everything that you're doing with this, is to help accountants understand and hopefully apply how they can help their clients in this new world that we're in terms of the seismic shift from equity financing to debt financing.
Yeah, absolutely. And that's what made me really excited about this as well, because we have actual data points to use to be able to speak more favorably about our clients and help them achieve whatever financial goals they have. Yeah, and as accountants, we all like data. Okay,
Yes.
Awesome. Well, we are going to go ahead and get started. I'll just start so that we can explain people who have probably never heard of this, because I know this was your own brainchild. You guys created this on your own. But how does the Cannabis Trust Score differ from a traditional credit score, and why is this distinction crucial for cannabis businesses?
What a great question. And it is very different. Most credit agencies that out there, and I just name a few, right? DNB, S&P, Moody, FICO, or Experian, TransUnion, Equifax, and the like, focus primarily on financial behavior, paying bills on time. That's mainly because it's so difficult to monitor and look into anything specific, right? Anything industry specific. Businesses can be approached or looked at as similar to individuals, because they have their own DNA, they have their own culture, they have their own structure, and it's very unique. But in order to do that, you have to look deeper. The way we approach it is, in addition to looking at financial behavior, which is in our ASK model, we utilize what's called an ASC model. We call it ASK, and that is assets, structure, and character. We focus on things that are not just financial. So we would look at a company's ability to pay, which is the assets, which is what people spend a lot of time on. We would look at the structure of a company, which is how decisions are made, what people they have in what seats, and where the bus is going. what governance they're using to run their company. Are there any complexities as far as decision making that should be considered in evaluating risk on whether you should deploy capital or provide preferred services to. We also look at character, and that's essentially the willingness. Character has these are what we consider soft items, right? Your SOPs, your emergency plans, your maintenance plans, your marketing plans, your retention plan, all the things that you created in order to run the company and have the discipline and the character, which is the willingness, in this whole picture. Most of the credit rating agencies are industry agnostic. They focus, like I said, on limited data points. That makes our job a little bit more complicated because we monitor a lot of data points that what the industry considered permission data, right? Data that we need to get permission to access. So companies see this immediate value in their financial planning and future growth, and there are and has been so far, and we think it's only going to grow, willing to work and provide us with the permission to access those systems that they use to manage on a daily basis, so we can aggregate the data and give them the data insight that they need to better manage their risk profile. So I think the difference, for the most part, if you consider other rating agencies, is that it's not just financially focused. And it does give you a complete picture of not only the financial health, but also the operational health of a licensed operator. I hope that helps. Chip, anything to add?
Well, Naomi, I think one other thing to add to what Dotan said is this is very industry focused, right? This is focused on the cannabis industry, which, as you know, and everyone knows, is very unique. It's the reason why we all love working in this, but it's also the challenge because it is a new horizon and it is a dynamic industry. One of the things that our score looks at, and Dotan touched on this, is also the state that a cannabis business operates in. And that's something that you don't get with other traditional credit scores, if you will. And it's really that holistic view of the health, operational, financial, and character, if you will, health of a cannabis business, because a license in California is different than a license in Michigan, for example. All right, there's different components. The licensing, the maturity of the market is different. And so our CTS score, or our CTS, takes into consideration that as well, which is something that I think, trying to be as immodest as I can about what we've built, that's something you don't find anyplace else.
So yeah, absolutely. Oh, go ahead.
Thank you, Chip. Naomi, I'm sorry, but I think that I'd like to emphasize the state ranking. We actually score and monitor each state individually and incorporate that score inside the score of the license holders. Why? Because they are operating in that environment. They subjected themselves to the challenges and the issues that particular environment imposes on them, right? Whether it's regulatory, tax treatment, cost of doing business, supply and demand, price compression, things that environment is subjecting those operators to. And you can't ignore, you can't just score someone in a silo. You have to consider the environment. And most operators don't really have a good visibility into what's going on around them. They, for the most part, they're so consumed with what's happening inside that ability to see how they measure up against their peers within the same environment is a very, very critical point or data point that can help executives that run companies make better decisions, and be more competitive and make the necessary adjustments. What we do know for a fact, and we touched upon the seismic shift from equity to debt, is when you move into debt, the standard goes up substantially. When you invest personally, the level of underwriting and understanding of risk is different when you deal with friends and family. And most of the money that was entered into the space, and in large numbers, were mainly friends and family, if you will. I'm just, generalizing, but the underwriting was very limited because of the hype that was there initially. We're moving into a whole different phase, and that is a much higher standard. And we're here to help elevate that standard so companies can actually have the opportunity to play in that space, where banks can do direct loans, or investors are going to consider that as an M&A, and so on and so forth. So again, piggyback on what Chip was saying about the state. It is critical not only for the operator and the license holder himself or herself, but also anyone doing business with them.
Okay, awesome. Yeah, and if I just even imagine trying to go back and create the Equifax or any of the original credit scoring agencies, I wouldn't even know where to start. And so, can you walk us through the process of how C-Trust analyzes 1,700 correlation points across 42 unique business categories? And so, how does this comprehensive approach benefit cannabis operators?
Well, first of all, they're not going to do it themselves, and
No.
and that is a given. I mean, it's so difficult to run a business as it is, that going back and looking for this data insight or data analytics with this complexity that you described, which, by the way, when we first started mapping out this solution, we didn't know it's going to end up with 1,764 correlation point or over 40 two business categories depending on the license type. Remember, we score by license type. So every license type, because they're not all born equal, as we all know, a cultivation is not treated the same or is subjected to the same issues and restriction and regulatory environment as retail or processing, or distribution, for that matter. It came about by essentially mapping out what are the things that we have noticed in the years of experience being on the distress side that causes the symptoms that causes companies to get there in the first place. So visualize, instead of peeling off the layers of the onion, visualize building back the layers of the onion. So it's all basically started by a process of elimination. What not to do, not what to do, but because the experience that we're bringing to this solution is what to avoid. So when you think about this approach from that perspective, you start by building up all those data points, if you will, within an organization that create the problem in the first place, and then you figure out a way by essentially triangulating data points, right, and looking for variances and anomalies of symptoms that essentially indicate that you headed in that direction, that certain things within your organization are working in such a way that is taking you off track, that is not on the increase or sustainability level. So that's the starting point. That's where it starts, is what not to do. Then, of course, over time, when you enhance the team with professionals like Chip and additional team members with the wealth of knowledge that the team bring to the table, that evolved even more so into a much more robust and much more comprehensive analysis with the knowledge and the experience that our team has combined. We also, when we start questioning ourselves, and you should, whether this is even accurate, relevant, or valuable, we did not know the answer when we first started. We had to run a bunch of experiments and conduct a study and build a simulator to see if it even makes sense. We had to go through all this. That's why we've been quiet for almost 3 years before we announced that we're here. It took time to go to market responsibly. The one thing about credit and providing advice that is really could determine the future of a company going forward, you can't just go and say, I got this thing and you need to believe it because I said so. We understand that people don't trust a number, but they could and will trust the process to get it. And it is a quite robust process to get it, whether it's the data aggregation, the data normalization, the cleansing of the data, the reconciliation of the data. And I know everybody in the audience here understand all these terms because you go through the same process when you do your work. So we had to go through all that to get comfortable that we have something here that we can stand behind. But we also did something else. We created a benchmark. We created what we call internally, and probably is already known by most, what's called Kappa Index. Kappa Index is a way for us to determine the confidence we have in our own score. And how because to have a score is great, but to have a confidence of that score, I think, is important. And we do provide that in our report. The way we accomplish the Kappa Index is we conduct an anonymized survey with subject matter experts with a certain data sets that is consistent every time. And we essentially get a 1 to 5 risk assessment from the subject matter experts in a pool of SMEs, subject matter experts. And then we take that and we average it and we compare it to the machine generated score. The further the distance, the lower the confidence. So what we pleasantly found out when we went live with this is that our confidence score and our machine generated score are within 90%. So that they are very, very close. And that's what gave us the confidence to say, we are ready with this product, we are ready with this service, and we're ready to go. And here we are. So just wanted to provide some more perspective on the genesis and the process. And it takes time. It takes time. It takes a mature approach, a responsible approach. And yes, we ended up with the numbers, staggering numbers of data points and correlation points, but it didn't start from that. It started from the bottom up. And we ended up with this robust algorithm and a system that we're very proud of.
Yeah.
Man, I couldn't have said any better. Yeah.
Okay, perfect. Yeah. Okay. And so one of the data points, which I think it's really unique, and I'm glad this is not part of my credit score, but you guys look at your standard operating procedures for the business, which I think is really unique. And first I would like to understand, how does that even work? Does the company just upload a Word document with their operating procedures? Because they can have these procedures but not even follow them. So do you guys have any additional step where you're monitoring if they're actually following these procedures that you're scoring them on?
Well, there are certain things computers cannot do. And it requires a human touch, an eyeballing, if you will. We do have analysts, and there's no shame in that. We are a fintech, but we do recognize the need for human touch. The way we approach, yes, they do upload. We do look at it. Whether they do it or not, we can probably know by the data triangulation process that we follow. If they don't follow their own procedure and they just did it to get the regulators off their back, and a lot of companies buy those SOPs, don't even create them, over time, we know if they use it or not, because if they update them, they use them. If they don't update them, they don't. That's essentially over time something that becomes way more valuable. Initially, it's hard to tell. I mean, we know that there's certain gaps. We can't physically go to every operator and see whether those SOPs match a practice, but we can see based on other correlation points, back to your correlation points, whether these SOPs are effective, and if and whether they were updated. There's certain things that computers can do, and that is matching content to content. So we are always constantly and will remain a company that strives for full automation. But at the end of the day, let's face it, there's certain complexities in this industry that computers cannot address, and will require what we consider the brain trust that is needed to look at certain things and certainly deal with anomalies.
Mm-hmm.
You know, Naomi,
yeah, that makes sense.
Your audience knows this well because they're dealing with it. There's a little bit of the weight test here, or maybe we call it the speed test. If we ask, and when we ask a CRB for their SOPs, if they come right away, that tells us something as humans. Doesn't tell the computer anything, but it does tell us something as humans about the velocity of how their operations are run. If it comes at the very end and we're kind of waiting on it to get it in there. And then once it gets in there, it doesn't look quite right on the surface. That also tells us something about the velocity and the health of that particular business. And that probably plays itself out mostly in the SME and the CAPA process, but it's an important thing. So I think for any of folks that are working as accountants, outsourced controllers, CFOs for cannabis businesses, having that stuff in place and having it at the ready is always better for the health of that business than it is we got to dig through stuff and we got to find it.
Got it. Awesome. And then, so let's talk a little bit about the use cases for the cannabis related businesses. How frequently should cannabis businesses reassess their C-Trust score, and what steps can they take to improve their score over time?
That is a great question, Naomi. And I think that from our perspective, we update the score, publish the updated score once a quarter. So the process is fairly simple. In the beginning, you go through a process called CTS IQ. That is essentially the questionnaire that we put out there to create your initial score, right? That's the first step. Every quarter, we aggregate additional information, updated information, financial and otherwise, and that will update or affect your score up or down. So from if you I'm a believer in and Chip knows, when we first met, I think it was my second word, 13 weeks cash flow, managing business on a weekly basis. I'm a believer that if you chop up your operation and management to smaller pieces and you monitor it very closely, you will reduce the margin of errors. You will reduce substantially. It's not that you're not going to make mistakes and things may go sideways, but you can react fast enough to changes versus looking at things quarterly or yearly. But from a credit reporting purposes, there's not enough data to report weekly or monthly. And it's also, time consuming for operators to interact with C-Trust more often than once a quarter, right? We think they got enough on their plate. So that was all takes effect on a quarterly basis. However, certain components of our score can be updated more often. We just don't publish it because, again, the responsible impact. There are certain things that companies do that will result in a change, positive or negative. And that change takes time to show up, to appear in the data, right? So we think that quarterly updates is the responsible approach, and that companies should probably take the operation to smaller pieces and run it on a weekly basis. I would recommend to anyone that asks what's the best way to move forward is, do you have a 13-week cash flow? That's my first question. But from a credit risk perspective, it is quarterly. The first process, the first step of getting your initial score is a little bit more onerous, a little bit more involved, and it should be, because that's your starting point. But the update is not time consuming at all, because most of the data that we aggregate to update the score is coming through to us through APIs electronically, by linking directly to point of sale, seat to sale, accounting, Intuit, QuickBooks, and other accounting systems. So we don't really have to chase the information anymore, but that's all part of the initial onboarding and permission process.
And then I think as far as improving the score over time, we are, as you can imagine, independent, objective. We have to be that way. We want to be that way because we're giving information and data about a cannabis business to that cannabis business owner. It needs to be an objective look. And then we also give that information with financial institutions. And they've got to trust in that score. And so trust is important. So important for us that we put it in the name of our company. But the actual improvement of the score report itself has a lot of data as to what contributed positively, what contributed negatively, and what contributed kind of on a neutral basis, if you will, to that score. I would expect, and I think this is a great place for advisors, accountants, CFOs, and others that are working with cannabis business owners, is to take that information and say, these are the places where your score was hurt or negatively impacted, and these are the places where we're gonna chop wood first, right? This is the place where we're gonna start with improving this, so that we can improve your overall score. The stuff that you're getting good scores in that positively contributed, that in my mind is a keep doing that. The stuff that negatively contributed is the start doing this or fix that. So it's a great opportunity, I think, for anybody to have that tool in their toolkit to take that score and then start to work on improving that score based on the different parameters and the data that's in the actual report itself.
Okay, perfect. And okay, so now let's talk about, why do we even care about the score? Why do we want to improve this score? So can you give us some examples of how this score has helped cannabis businesses overcome specific financial obstacles or obtained capital that they weren't previously able to obtain?
Yes. Just as a reminder, we launched the company July 9th this year. So I'm going to talk about what we've done with one company that was part of our pilot before we even announced that we're available to everyone. They scored low. They recognized their issues, one of which was essentially using retail cultivation, piling up cultivation cost and liability on top of a retail license, because that was the only thing that was carrying the company. They needed to make some restructuring or changes, separating the financials, adding additional retail, diversifying and allowing their product to be sold in multiple locations rather than concentrated in one. They needed to improve some cash flow, positive cash flow. They need to essentially refinance out of the existing debt because the cost of the debt was not sustainable. And that's one of the things you're going to see out there. And we're going to talk, I think we should talk about the debt market report that Whitney Economic just released, because the refinancing opportunity is real and it's here today. This is not future growth. This is the problem today. So this particular company wanted to get their score because they want to get out of existing debt that is not sustainable, that if they can show objectively that they can pay for the debt, they have the ability to pay, they have the discipline to pay, and they have the willingness to pay, which is, again, the asset, structure, and character. And the score is certified or approved by a third party, that they can have access to more affordable capital. Fast forward a few months, that company came back to us and said, hey, we need to rescore because we're ready. We've made all those changes. We've learned from the data insight provided that if we do that, we will be more credit worthy, more valuable. Our risk will be lower, and we should be able to obtain lower cost capital. They are currently in the process of getting rescored, and the score is going to be updated and provided to a real lender that is interested in giving them, and this is a substantial loan. This is not a small loan, offering them financing at nearly half the rate that they're paying today. So why do they want it? I think the refinancing opportunity and the cost of capital today is one reason. They want to get out of that, and they want to have access. And to go and tell everybody yourself that you are credit worthy without anything showing for it, I think it's an uphill battle, because they've done it for years. They told the same story over and over and still ran into some issues trying to represent themselves. I think the value in a third-party objective perspective and a score with a data insight to how to improve it is valuable to companies, and I think it's much needed today. The flip side of it, of course, on the lender side, is the monitoring component. The fact that you have a score is great, but I think the value for lender is the ability to see what you're doing over time and get it updated early enough so if there are any problems, you can react, you can fix, you can do something to improve rather than go down the path of default or negotiating, because banks don't have the same risk appetite as private lenders, where default is part of their model. Banks cannot afford more than 2%. If you think about financial institutions that are regulated. So risk monitoring and risk management is a critical component in their decision to place the loan in the first place. So I think it motivates both sides for the reason I just stated. And we do have a real case study that was, like I said, early on as a pilot, that is now looking to refinance. And we believe that this is going to be very helpful in accomplishing that.
Awesome. We do have some audience questions. I'm going to just pop those in here. So Tony is asking, how are you assessing pre-revenue firms or social equity capital seekers?
Great question, Tony. We work with banks. Banks do not finance or deploy capital in the form of debt to anyone that is less than 2 years old. That is a rule of thumb. If you go to a bank and seeking an SBA loan or any loan, you have to have 2 years of history to get started, and that's where we live. There are options to get financing for pre-revenues, startups, and social equity operators, but most of those are available with other companies that have different ways of looking at that risk. You got the Fontana that will start lending if you 3 months old, meaning that the first 3 months they want to see you deploy your own capital at risk, or friends and family, or raise money through the equity market just to show that you are committed. But they'll lend you as early as 3 months. And I think they're a good option. However, you want to graduate. You want to graduate to more traditional lending. And that happens at the 2-year mark. So we don't really help. I don't believe, not yet. We may be able to do it down the road when we have more predictive capabilities based on factors that don't necessarily attach to revenue only. But at this time, we've focused on what we consider the 2-year mark graduation. That is our ideal, license holder operator that can benefit from this solution.
Okay, awesome. And Nancy is also asking, so how long is the process from starting to getting a score? So a cannabis operator signs up with you. What does that look like before they're able to start looking at their score?
As quick as 5 days and as long as 2 weeks. And it really depends on the completion. We can score any company with partial data, but it's not going to be a good one. So the motivation to have a complete set of data, and I can't reiterate it more, and this is perfect for this audience. If you can advise your clients to be ready, to have a data room, to get all their documents in order and updated on a regular basis, that's one huge step toward readiness for what's coming. Because you're going to be dealing with people that are going to want to have a way to look under the hood in order for them to make decisions, whether it's M&A, lending, insurance, renewals, AR risk, whatever the case may be. You want to be ready. So that's step number one. The more ready and cooperative the license holder is, the faster the score can be generated. So we've done it as quickly as 5 days and as slowly as 2 weeks. The one thing we don't like to do and we can't afford doing is chase information. So that if we start doing that, then it becomes inefficient, and usually the outcome or the score is going to be as such that maybe that's the motivator that they need. Look, my score is so low, but if you did the following, it could go up, because we need to have full visibility into this entire engine that you built before we can tell you whether this engine can. So yeah, I hope that answers.
Yeah. Hey, Naomi, I did want to touch back on something that I think it was Tony that asked the question about social equity. We are in the process and recognizing the importance of social equity applicants in our industry and the value that they bring. We are talking to regulators about using our monitoring capabilities, and Dotan touched on this a little bit, and a score in kind of future social equity SBA type loan asset program. So on the horizon, we're forming that as we go, and it's mostly because we recognize that, look, this score has got to serve the complete cannabis industry, regardless of where lenders are. Our goal is to serve not only the financial institutions that want to lend into this space and are lending in this space, but also all of the cannabis operators that are moving this industry forward. So just wanted a little bit of teasing for what we're working on with the future.
Okay, awesome. And then, of course, we've got a question from Kim. We're a group of accountants, so we want to know where the money comes from. So how do you guys get paid? Does it cost to get a score? Does the cost to be on the platform? Do the creditors have to pay for the score? How does all of that work?
Great question. We do not charge license holders for their score. This is free to operators. It's their score. We also have a very strict policy that we do not release the score without the consent. Similarly to how your FICO works, I don't know your score unless you want me to know it. So that gives at least an opportunity for these companies to improve it, to do some work, to be ready to go with their score, not necessarily have one and all of a sudden it's all over the place and everybody knows it. No, it is not available to everyone. It is free to operators. How do we get paid? We have 3 revenue models. And we have a great CFO, so I mean, I'm sure he can expand on that. We have 3 revenue models. We have the debt under monitoring, which is mainly offered for banks, and we basically take basis points of the loan amount for the life of the loan, to continuously provide portfolio insight. If the bank has multiple loans, they can see where everybody is, where they're at from a risk score perspective. Operational issues. There's data value that we provide these financial institutions that they especially on a portfolio side, that is being paid through debt under monitoring basis points. Second model is subscription. That applies primarily to insurance companies, MSOs that would like to monitor their AR risk. Those are more subscription model. And then we have the transactional model, which is one-off. If you are doing an M&A or you just want to do a deal with a company and you want to have a credit score to understand how to extend terms, if you will, then clearly the company want to work with you. Otherwise, they wouldn't consent releasing their credit to the requesting party. The requesting party will pay one-time fee to obtain the credit report and the credit score that they would need for their purpose. So that's how we get paid. But again, very, very focused on data security, so it doesn't leak or go anywhere it shouldn't go, and making sure that the score is owned by the operators and released with their consent.
Yeah. And always, just to put another point on, always free to cannabis related businesses. So they can go get their free, it sounds like a little bit of a commercial as I'm talking, to get their free C-Trust score, get their free CTS, just go to ctrust.io. No, thanks for that shameless opportunity for the shameless plug. But no, seriously, it's important for us that CRBs have and understand their score, understand what goes into it. So that's why, one of the main reasons why we offer that for free.
Awesome. And this leads me directly into my next question, because you mentioned mergers and acquisitions. So can you explain how the C-Trust score might influence merger and acquisition decisions, and how accountants can use this information to advise their clients?
That is a good question, Naomi. And I think that just from an alignment perspective, if you are a current operator and you have a score and you want to look for like-minded companies to merge, because the biggest problem with merging is, and people don't pay much attention to it, is that cultural, financial, and operational alignment. If nothing else, you'll be able to see where you stand compared to where they stand, what their strong points and what their weak points from a risk perspective. You know, that's our focus. And you'll be able to make better decisions. I think it's going to save a great deal of time and money in the due diligence process. I think it's going to help you understand what it is that you may have to spend resources on improving if you are to take on and consolidate operation. It's because it can be overwhelming. Mergers are complicated. It's no different than marriage. You have to figure out, strong points, weak points, and how things should work out. And I think that just helps provide that data insight to make those critical decisions, to make sure that the M&A is successful. I would even argue that some of the M&As that failed with this tool could have either identified the failure much sooner and avoid going this long dating period, or they could have date better, if you will, for lack of a better description, or focus on the right, on different things that ultimately resulted in a failure of that merger. So I think it has a lot of value and in saving time, money, and providing data insight.
People, I mean, in mainstream industries since the dawn of time, we've talked a lot about quality of earnings, and that's in our industry is also morphed into quality of operations, quality of the financial health. One of the things that the C-Trust score does is not only gives the information, but also affixes an assessment of the quality of it, and that's that impacts a company's score. So I think it's a perfect opportunity for anybody involved in M&A work in this industry that they can have another piece of information to be able to advise their client, not whether to do the deal or not do the deal, but here is the parameter, the full spectrum of risks associated with doing this deal. Because again, our score is a credit score, but it's also a risk score. And everyone likes to understand the full parameter of the risk and then make business decisions about it. I think that the C-Trust score in an M&A environment in the cannabis industry is a great place for advisors, for accountants, for controllers to be able to expose their client, the prospective acquirer, as to the risk, the full broad spectrum of the risk associated with this particular deal.
Got it. Awesome. And I think you may have mentioned this, but Kim is asking, what is the scale? But on top of what the scale is, also what's like considered a good score, and where are people falling at this point in time?
The range, Kim, is 200 to 800. So the lowest is 200. We haven't seen 200, but we did see high 300 and low 400s in our scoring, including publicly traded companies. Interestingly enough, the study we conducted included scoring several companies, and because of data, we had to rely on some of the publicly traded because their information is public. And we scored one of the companies, and they got a really low score. And lo and behold, 3 months later, they filed a bankruptcy. It maybe 6 months later. I don't remember the exact time. It was sometime later. And we felt very good about our ability to assess the risk at the time and the factors that make up that score. What we've seen so far, and to our pleasant surprise, that most of the scores fall between high 500, low 600 that we've seen so far. That's where we see the range, which is, it's certainly above the midpoint, quite substantial above the midpoint, but it has another level of importance because a score is not only to evaluate your risk, but it also to evaluate and determine your rate. And we developed what's called a risk-based pricing engine that we currently made available to banks, but now hopefully soon, right before MJ Unpack, we're going to make it available to license holders, where they can actually go into this pricing engine and they can put in whatever financing or refinancing terms they're looking for. And based on their risk profile, they can see what rates they should expect. So they can start analyzing their own, cash flow projections with new rates at certain terms. But of course, it's all contingent upon whether they can get that score or be within that bucket, because our scores are divided to 5 buckets: poor, very poor, poor, fair, good, and very good. Those buckets are also defined by a range of numbers. So you can have the low end of fair and the high end of fair. And then if you move from one bucket to the next, it can make a material difference in your cost of capital. And that's how we're approaching it. That the risk score is not only operational and financial health, but it's also a way for lenders, mainly banks, to price the debt when they look into these types of loans. It also a way for banks to use it in loan covenants, where depending on where your score is, it can trigger their certain events. So there's a lot of applications that this score can work with and used by. But I hope that answers. I think I went a little bit outside the scope, but I hope that answers the question.
Yeah, awesome. Chip, did you have anything?
I think just to add, I think part of the question was about accountants using that, or how can they advise their clients on it. I mean, everyone, even if it's not where you want to be, you like to know where you are and you want to know where you're going, right? So that initial score, and I think the caution to CRBs is when you get that first score, if it's not what you want it to be, don't panic, and accountants don't, tell your clients not to panic. It just means now the path to improving your company and to getting the lending terms that you want, to getting the deals that you want, that path is laid out before you, right? So you know what your initial score is. Do the work, help your clients do the work to get to where they want to be, and then have them get another score and see that improvement in the score. And it's, we made it easy. I mean, it's numerical. We're human beings, and especially accountants. We think in numbers, right? We see a number, we assign a value to it and a qualitative value to it. So I think that's an important place for accountants to help out their clients is that improvement in the score. Get it, understand the aspects of it, and then do the work to improve it.
Awesome. We do have a quick question from Tony, but I have like two more questions that I want to ask as well, and we have a couple of minutes. So Tony is asking, you mentioned banks numerous times. Which banks are actually working with you guys?
Well, 170 banks are on the GreenCheck marketplace, and we have partnered with GreenCheck. We have a data partnership and a relationship with all of their banks. So it's credit unions, state chartered banks, of course, none of the big banks, and the federally, the national banks are in the space yet. But the latest numbers I've heard of banks in the space today is over 900. I don't have the exact number, but there's a lot of banks that are taking deposits today. I believe that banks are realizing that in order to maintain and keep those deposits, they need to start competing on loans. Because there are a handful of banks right now, CSV Bank, for example, in Maryland is one of them, that have deployed meaningful capital in direct loans to CRBs. The more banks do it, the more deposits they're going to attract. It's just simple as that. And I think the fact that we have such large number of banks already banking the space and taking deposits, to me means that a lot of them are going to start either looking or developing lending policies into the space directly to their customer base. And of course, not only preserving, but attracting more deposits, which is, what banks know how to do, take deposits and make loans. So there are several banks that are in the space that are working with us to develop this program. Like I said, this is early. But we do think that great things will come out of that relationship with GreenCheck and their 170 plus banks that are currently using their platform.
Yeah, we had overwhelming response. I would characterize it for a webinar that we did specifically with GreenCheck, specifically to financial institutions, and the amount of banks that either are in this that want to understand this whole dynamic or want to be in this, as Dotan said, are making deposits or taking deposits now and want to make loans in the future. They're in the banking business, right? They want to understand the risk. And so that's been a great place for us to help them out.
I actually saw the question below, Naomi, and I pulled out the the chart of the rates and the various buckets, because I think that they're asking which score fits in what bucket. So to be very specific, anywhere from 200 to 330 is considered very poor. Anywhere from 331 to 450 is considered poor. Anywhere from 451 to 570 is fair. Anywhere from 571 to 690 is good. And anywhere from 691 to 800 is very good. I hope that answers the question. A little bit more scientific, but I think this audience needs to know the exact numbers. Otherwise, I will hear about it later.
Accountants are the best people in the world because we got to have those numbers. We got to know what.
I hope you wrote it down. If not, I hope you wrote it down. If not, happy to connect with you guys later.
Yeah, absolutely. And then this kind of leads into my last question that we have time for is how can accountants use this trust score to help their clients secure better lending? And there's a couple of parts to this question, either better lending, better relationships with vendors, or better manage their accounts receivable and payable.
Why don't you start, Chip?
Well, I think the first thing is encourage your clients to get their C-Trust score, right? So that we have a benchmark. They have a benchmark to understand where they are, and then really digest the information that's in that score, because there's a lot of stuff in there, a lot of things that as I mentioned before, positively contribute to it, and then use that as part of their toolkit to help improve where they're going with their business, improve their operations, and look at both the financial health and the operational health. And again, our score touches on all of that. So it's more than just kind of the financial piece. It's really that holistic view of where that particular company is, and their ability to borrow money at competitive rates, the ability to do strategic transactions that make sense, and the ability to understand what their risk is and their risk exposure is. So I think it clearly starts with getting your score and then working shoulder to shoulder accountants with the business owners in terms of what does that score mean? Let's digest it and let's figure out how we move forward.
I will add to this a couple more things. First, we are always working to expand our subject matter experts circle. We think that that's a way to be part of this process and understand, how it works, because we're here for everybody. We're not here for any particular group or company or service. We're here to give everybody an objective perspective into a company, so that company, that license holder can get better terms. But also credit repair. We do not do that. We can't. We have to remain Switzerland. We can't go and advise and benefit from advising on how to get a better score, because I think it taints our objectivity. And neutrality and objectivity are critical to the trust that we're building with the marketplace, all stakeholders. So anybody on this call is more than qualified to take that role, to be a credit repair advisor. We'll spend time with them. We'll talk. It's easier for us to deal with a group of subject matter experts that want to get into that field than it is to work with all the companies. We're on it. First of all, the objectivity is an issue, but also we're not built to do that. So we will certify or partner with companies or professionals that would like to help companies improve their credit. And a lot of it, believe it or not, a lot of it is what you do anyway. Helping them get it organized, categorized, reported correctly, financial and cash flow tools that these companies need. You're doing a lot of that work, now. There may be additional steps and additional things that may require a little bit of training, but for the most part, you got this. And I think that that's an opportunity for everyone on this call.
Awesome. I love it. We always should be looking for ways to pivot and expand, because things always shift in business, and this is, I like this. I'm going to look more into this to see if I can use this with my clients as well. But thank you both so much for your time. Just any last minute comments on like maybe where do you see this evolving? What are your future developments with the C Trust score?
Of course. Great question. Where I see it evolving, at the midpoint, $92 billion debt market in the next decade. That's where I see it evolving. I think the industry, and that's based on a Whitney economic study of sustaining the current financial and the growth of this industry. There's anywhere between 10 to 18 billion of refinancing opportunities that exist today. I believe that the industry is going to need to elevate its standard to be able to qualify for these financial vehicles that are available and available now. This is not pie in the sky. This is not 2 years down the road. It's available now. And last words, get ready. Get ready for this trend because equity may come back. Some of it may come back. And I think it's going to be very specific and localized and very strategic. It's not going to come back the way it presented itself in the beginning. There's going to be more debt. There's going to be a higher standard to adhere to. And I think this is an opportunity to get ready, get your clients ready, and be in the game that the puck is going, not where the puck is at.
Awesome. Thank you. Any last words, Chip?
Just thanks again, Naomi, for having us on and for the conversation. The questions have been great, and especially from the audience out there.
Yeah.
Really appreciate them asking some pointed questions. You know, we're all in this together. We all want to see this industry go the same place, and so I really appreciate the questions.
Yes.
Awesome. Thank you. Thank you all. And all right, we'll wrap it up here. Thank you for being here.
Thank you for having us.
Bye, everyone.
Take care.
Yep.